everyone, you're welcome to this week's Business and Investment Tips program, a production of Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the key takeaways from the IMF staff visit to Nigeria. Last month, the International Monetary Fund's team, which plays a supervisory and monitoring role globally, held meetings with Nigeria's fiscal and monetary authorities to discuss recent economic and financial developments along the economic outlook for the country. This team also came up with policies and reforms to adopt in light of the risks facing the economy. Following the staff's evaluation, a report is subsequently provided to the executive board, whose views are then transmitted to the country's authorities through a process known as the Article 4 consultation. The Article 4 consultation report, which is published twice in a year, offers recommendations on a broad range of issues, from fiscal and monetary policies to healthcare policies. During the meeting, the committee, the IMF team, noted that the country's post-pandemic recovery was gaining momentum due to the robust growth in the services and agricultural sectors. It further acknowledged the broad-based growth seen in all sectors, with the exception of the oil sector, where the production was constrained by security and technical challenges. The committee expressed concern about the persistently high inflation rates, which reached an 11-month high of 17.7% in May 2022 due to the resurgence in food prices that was exacerbated by the conflict in Ukraine. This further raised concerns around food security, as more than 40% of the population is assumed to live below the poverty line. We note that the inflation concern is what made the CBN turn hawkish and deliver its first rate hike since July 2016, an increase of 1.5% to 13%. We believe that the decision the central bank took was a step towards restoring the signaling effect of the MPR. However, the committee noted that the unconventional measures taken to control liquidity in the financial system continue to impede the monetary policy transmission, further complicating its inflation-fighting efforts. We agree, as we have said, that the hike in MPR was largely attributed to making the fixed income market more attractive to foreign portfolio investors, FPIs, to increase foreign exchange inflows rather than curtailing the inflation rates. Regarding the external sector, the committee highlighted the positive impact the improved trade balance, which is the difference in the value between the country's imports and exports, had on the country's current account deficit, thanks to the reduced import bill and the higher net oil balance. The current account deficit is the shortfall between the money received by selling products to other countries and the money spent to buy goods and services from other nations. This did not, however, ease the pressure on the foreign exchange markets, as exchange rate premiums in the black market have remained constant since October 2021 in the range of 40 to 50% above the official FX rate. They also pointed to the poor build-up in the foreign reserves despite high oil prices, as the gross FX reserves fell from the peak of $41.5 billion in September 2021 to $38.6 billion at the end of May 2022. This is despite the $5.25 billion raised through Eurobonds in the last year and the inflow from special drawings rights (SDRs) allocation. We expect that the exchange rates will continue to be pressured by weak investor confidence, which has affected foreign capital flows, low oil remittances, and a huge demand for foreign currency. On the balance of factors, the committee expects that the GDP will grow by 3.4% in 2022, led by the sustained recovery of the private sector, the start of operations at the Dangote refinery, as well as the decisive steps to mobilize revenues. Damaging risks to these upsides are the further deterioration of the security conditions, the upcoming elections, costly petrol subsidies, low vaccination against COVID-19, and higher global interest rates. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to info@getfinanceandinvestmenttips.com or send an SMS to 070-8246-3747. Stay blessed.